Well, South Africa's fourth quarter consumer confidence index declined by 2 index points to -3. The drop reflecting confidence levels last seen at the onset of the global financial crisis in the second half of 2008. Joining us now to chat about these findings is Cees Bruggemans, consulting economist over at FNB. Thanks so much, Cees, for joining us this afternoon. So let's get into your reading of the deterioration we've seen here, because of course we're moving deeper into negative territory.
The big decline took place in the second quarter, also to this level. We had a slight bounce in the third, but now we're back at -3. -3 is well below the long-term average. It is a low level of confidence. It reflects the kind of economic circumstances we had in mid-late 2008. It suggests a very slow economy, and that is where we are.
Yeah. Case, there seems to be a parallel here between the way that investors are behaving and the way that consumer confidence is going as well. Investors are buying the South African stock market despite the fact that they're fearful of the macroeconomic situation, and it seems that despite the people that you survey being a little bit pessimistic about the SA economy, they say about their own positions that everything's fine. Is that a psychological thing? They're in denial, or is this a real phenomenon?
Well, to extend your comparison with the stock market, companies are also still showing growth despite the behavior of investors. So when it comes to the household sector, you have these three questions, and their own finance question continues to be answered in positive territory. In fact, it's slightly ticked up. It is the other two questions which have regard to the broader economy, which deteriorated further. And then also the question, is now a good time to buy durable goods, also deteriorated further. Suggesting a lack of certainty, an increase in uncertainty, given the circumstances that we find ourselves in, like the investors that you were referring to.
So to what extent, Cees, is this telling of the household consumption expenditure that we're looking forward to come 2013?
Very much these levels reflect the kind of slowdown that we have seen in consumer spending in the course of this year. And to my mind, these kind of conditions are basically extrapolated into 2013. I don't necessarily see them worsening from present levels, but essentially continuing, which I think is bad enough.
Okay, so let's apply these statistics that you've kindly given us this morning to the real world. You talk about the propensity to buy durable goods deteriorating notably, and that will obviously have implications for certain retailers, especially with this period coming up. So I mean, how do we apply these statistics, do you think?
We see it reflected in the furniture and household appliances sector, where things have slowed down in the course of this year, and that then ultimately is a reflection of a consumer who both has a maturing replacement cycle, the recession is 3-4 years behind us, but then also has this increased uncertainty about the environment going forward, and translates this into greater caution when buying, especially the big ticket items. On the car side, we've seen something similar in that the growth rate has slowed, but ultimately that particular buying phenomenon has not yet ended.
Taking a look at the interest rate environment that we're in right now, Cees, of course, 30-year lows. What's your view on where we're headed there? Because to a large extent, it's the fact that we are sitting in a low interest rate environment that's keeping consumers spending.
Well, certain types of borrowing continue to be supported, while other types of borrowing are not going anywhere. To my mind, that is more a reflection of the changes in the banking system, the regulatory changes, both internationally and locally. When it comes to interest rates, yes, we're at very low levels. It supports the household sector, but it doesn't seem to give rise to much of an increase in growth in spending, or for that matter in borrowing, beyond than what we have seen, unsecured lending faster, but mortgage lending actually very little, and overall household debt rising essentially in higher single digits, but in line with income. The economy is weak. Everything suggests that this condition will continue into next year. And if it wasn't for the uptick in inflation, I think we could have looked forward already to further interest rate easing. It is the trade-off, I think, between the inflation environment and the weak economy that is holding the Reserve Bank back at this point in time. And they probably need more clarity about events going into next year to decide whether they want to take yet more action or whether they will hold back.
Having a look at these numbers and having a look at the trend over the last year, maybe even a couple of years, maybe even beyond actually, back to the start of the international financial crisis which affected us so badly. Do you see there any chance of a break in this trend in 2013, or is it more of the same? I'm all right, thank you very much, but I don't like the economy, and I'm not really, although I'm okay, I'm not going to go out and buy any big ticket items.
We are in a very long play out in terms of recovering from what happened 4 or 5 years ago internationally, but then also locally. There is evidence of some improvement in the United States. China supposedly cyclically should be improving slightly, while Europe continues to disappoint, but should also in the course of next year show a very modest kind of rebound from what it is experiencing at this point in time. But none of that is really strong enough to change the playing field. So we remain with very modest growth generally. We continue to see very supportive monetary policies and governments struggling to essentially get their fiscal finances back under control. This is year 5. And, you know, in most boxing fights, you go to round 10, or if you wish, round 12. So we have some years to go in many of these areas, countries, and that doesn't exclude ourselves. We are in a slow growth environment, and lots of structural reasons for that.
In the meantime, we keep our eye on the exchange rate and the volatility we're seeing there. I mean, the depreciation in the rand exchange rate since the first quarter of this year rather, has also started to weigh on the cost of those durable goods, and that impacting consumers and where they choose to spend how in a very big way.
Sure, and if these conditions continue with the same intensity domestically, then you would expect further weighing down on the currency. On the other hand, what we're discussing internationally, if these central banks continue to be as supportive as they have been, that then remains with yield seeking ultimately a feature that continues to favor us with capital. But our domestic situation has changed to such a degree with debt down ratings, and then specifically the labor environment, that more and more people are asking questions, and in the process then it is not just your debt that gets downrated, but in fact the currency as well. Also a function of the slow growth rate and the increased balance of payments constraint.